What if I told you that before Bitcoin's last major price move, a specific AI prompt flagged it 48 hours in advance? It's a bold claim, and it probably sounds like every other crypto promise you've ever heard. But stick with me, because the truth is far more nuanced and, frankly, more useful. This isn't because AI is a magic crystal ball. It's not. It's because it can process and cross-reference vast, disparate datasets at a scale and speed no human ever could. It finds the echoes of the past in the noise of the present. It reads the patterns we miss. Now, before we go any further, let's get the most important thing out of the way. This is the critical disclaimer. No AI, no algorithm, no human analyst can perfectly predict the future price of any crypto asset. The market is a chaotic system influenced by countless unpredictable variables, from regulatory crackdowns to sudden shifts in global politics. Anyone who tells you they have a guaranteed formula for predicting prices is not being honest with you. What we're discussing today is not a predictive tool, it's a probabilistic one. It's about shifting the odds slightly in your favor by making more informed decisions. It's about enhancing your judgment, not replacing it. Think of it as upgrading from a simple map to a full satellite view with weather overlays. You still have to drive the car, but you have a much clearer picture of the road ahead. The goal is to identify periods of high confluence, where multiple independent signals all point in the same direction, suggesting that the probability of a significant move, up or down, is elevated. This is about risk assessment and context, not prophecy. So, how does it work? AI can analyze on-chain data, sentiment patterns, historical cycles, and macroeconomic signals simultaneously. It can then flag when the combined state of these indicators looks remarkably similar to conditions that preceded major price moves in the past. That confluence is incredibly powerful. This brings us to the framework. There are 4 core signals that AI is uniquely positioned to track and synthesize. While a human analyst might specialize in 1 or 2, monitoring all 4 in real time is nearly impossible. Let's break them down. First, and perhaps most crucial, is on-chain activity. This is the raw, transparent data from the blockchain itself. We're asking fundamental questions. How many unique wallets are sending or receiving Bitcoin? This is your active addresses metric. A sustained increase can signal growing network adoption and demand. We also look at exchange flows. Are large amounts of Bitcoin moving onto exchanges, which might suggest an intent to sell? Or are they moving off exchanges into private wallets, a classic sign of long-term holding, which reduces the available supply? A historical example of this was in late 2020. While the price was consolidating, on-chain analysts noted a massive, sustained outflow of Bitcoin from major exchanges. This supply shock was a key tell that large players were accumulating, anticipating a price rise. The AI can spot these trends far earlier and with greater statistical confidence than a manual chart review. The second signal is market sentiment, often quantified by the Fear and Greed Index. This composite index pulls from various sources like volatility, market momentum, and social media chatter to produce a single number. From 0 for extreme fear to 100 for extreme greed. Is the market emotionally overextended? Extreme greed can be a powerful contrarian indicator, suggesting the market is euphoric, fully invested, and vulnerable to a reversal. Conversely, extreme fear can signal capitulation, where even strong hands are forced to sell, often marking a market bottom. The AI doesn't just look at the absolute number, it looks for divergences. For instance, in early 2021, as Bitcoin pushed to a new all-time high, some sentiment indicators failed to reach a similar peak. This bearish divergence suggested the rally was losing emotional momentum, a subtle warning sign that a correction was becoming more likely. Third, we have macro correlation. Crypto does not exist in a vacuum. It's deeply intertwined with the broader financial world. We need to ask, what is the Federal Reserve doing with interest rates? Historically, lower rates and increased liquidity have been rocket fuel for risk assets like crypto. Higher rates, on the other hand, tend to pull capital towards safer, yield-bearing assets. The AI can analyze decades of market data to model how assets like Bitcoin have reacted to different monetary policy environments. We also track the US dollar index, or DXY. Often, a strengthening dollar creates headwinds for Bitcoin, and a weakening dollar provides a tailwind. The AI can quantify this inverse correlation and flag when it's particularly strong or starting to break down. For example, the AI could identify that in 8 of the last 10 instances where the Fed raised rates by more than 50 basis points while the DXY was above 105, Bitcoin experienced an average drawdown of 15% over the following 60 days. That's not a prediction, but it's a powerful piece of context. And the fourth signal is social sentiment. This is about measuring the attention and emotion of the crowd. Is retail interest spiking or fading? The AI scans millions of data points from platforms like X, Reddit, and Telegram, analyzing the volume and tone of conversations. It also tracks Google search trends for keywords like buy Bitcoin or crypto crash. A massive spike in buy Bitcoin searches after a long period of quiet can indicate that a new wave of retail FOMO is entering the market, which often coincides with local tops. Conversely, a spike in Bitcoin is dead posts during a deep correction can signal that public sentiment has hit rock bottom, a classic sign of capitulation that often precedes a reversal. The AI can differentiate between organic, sustained growth in interest and a sudden speculative frenzy, providing a much-needed filter for the noise of social media. When all four of these signals, on-chain strength, sentiment extremes, macro tailwinds, and surging social interest, align in a specific, historically significant pattern, the probability of a major move increases dramatically. The AI's job is to be the tireless watchman, waiting for that perfect alignment. So how do you put this into practice? This brings us to the prompt itself. You can use a powerful large language model like ChatGPT 4, which has the ability to browse the web and synthesize information. Here is the exact prompt that I use, and you can copy it from the description below. You type, act as an expert crypto market analyst. Analyze the current state of Bitcoin by synthesizing data from the following 4 domains. 1. On-chain metrics, referencing data on active addresses, transaction volume, and exchange net flows. 2. The crypto fear and greed index, noting its current level and recent trend. 3. Current macroeconomic conditions, specifically referencing the latest Federal Reserve interest rate policy, and the trend of the US dollar index, DXY. And 4. Social sentiment, analyzing recent trends in search volume and social media chatter. Based on a synthesis of these 4 signals, identify 3 historical periods from Bitcoin's past where the combined data profile was most analogous to today. For each analogous period, describe what happened to Bitcoin's price in the subsequent 30 to 60 days. The key here is that you are not asking it to predict the future. You are asking it to find historical parallels. It won't tell you to buy or sell. It will give you a context map, a set of historical case studies that sharpen your own judgment enormously. It transforms raw data into actionable intelligence. So let's look at a backtest. What has this AI framework gotten right? And just as importantly, where has it failed? 3 weeks ago, running this exact analysis, the AI flagged that current conditions, with strong on-chain accumulation, neutral sentiment, a pausing Fed, and low social volume, looked very similar to 3 previous consolidation breakouts. Bitcoin was trading at around $67,000. Within 72 hours it broke out and surged past $71,000. That was a successful flag. However, let's look at a failure. 2 months before that, a similar query flagged a bullish confluence. The on-chain data was strong and sentiment was fearful, a good contrarian sign, but it failed to account for an unexpected macro shock, stronger than expected inflation data, which sent the dollar soaring and risk assets tumbling. The breakout never happened. The market chopped sideways. This is a perfect example of the system's limitations. It can't predict external shocks. It raises your accuracy, but it does not, and will never guarantee outcomes. So how can you use this practically and responsibly? I recommend running this analysis once a week, perhaps on a Sunday, to set your context for the week ahead. Save the AI's output in a journal. Note the historical analogs it provides. Then, throughout the week, see how the market actually behaves. This creates a feedback loop for your own learning. When the AI flags a high conviction setup, it doesn't mean you go all in. This is where sound risk management is non-negotiable. It might mean you consider taking a position, but you do so with a clearly defined stop loss, a price at which you automatically sell to cap your potential losses if the analysis proves wrong. It means using responsible position sizing, never risking more than a small percentage of your portfolio on a single idea. The AI provides the what, you must provide the how much, and the what if I'm wrong. To recap, AI is not a crystal ball. It is a powerful data synthesizer that can give you a significant edge by analyzing 4 key signals in unison: on-chain data, market sentiment, macro conditions, and social chatter. By prompting it to find historical analogs, you build a map of probabilities, not a book of prophecies. That's the honest truth about using AI in crypto. I use this framework every single week to inform my own market perspective. The full detailed prompt is in the description below. I encourage you to try it for yourself. Run the analysis, and then come back and tell me what it said in the comments. I'm genuinely curious to see the patterns it finds for you, and I read every single one. If you found this breakdown valuable, subscribe for a new AI crypto analysis every single week. Thanks for watching.